Something unusual is happening in global markets. Not just volatility, not just another geopolitical headline, a chain reaction. Oil is spiking, shipping routes are breaking, energy markets are tightening, and investors around the world are suddenly asking the same question. Is this the beginning of a global market shock? Because when energy supply gets disrupted, the consequences move fast. Stocks fall, inflation rises, central banks lose flexibility, and the entire financial system starts repricing risk. Today, we're going to break down what's actually happening, how the shock is spreading across markets, and most importantly, what investors should be watching next. The first signal is the scale of escalation. Hundreds of targets have already been hit in what analysts are calling one of the most aggressive regional escalations in decades. Military bases, energy infrastructure, strategic facilities. The pattern suggests something much bigger than isolated strikes. When conflicts begin targeting infrastructure instead of just military assets, markets start to react differently. Because infrastructure attacks directly threaten economic systems. And once markets see that shift, they stop pricing headlines. But one of the most alarming developments isn't oil, it's water. In several parts of the Middle East, desalination plants have become strategic targets. These facilities convert seawater into drinking water and supply the majority of fresh water in countries like Kuwait and Saudi Arabia. In some regions, up to 90% of drinking water depends on desalination. If those facilities are disrupted, it doesn't just create a humanitarian crisis. It destabilizes entire economies, which means the battlefield is expanding beyond traditional military targets into critical civilian infrastructure. And markets reacted immediately. Oil prices surged past $115 per barrel, marking one of the most dramatic spikes in recent years. In fact, analysts are comparing the disruption to the historic Suez Crisis of 1957, one of the largest supply shocks in modern energy history. Oil didn't just move higher, it exploded. And when oil spikes like this, the effects ripple through every layer of the economy. Transportation costs, manufacturing, agriculture, logistics, everything depends on energy. At the same time, supply disruptions are spreading across multiple producers. Production cuts, infrastructure damage, shipping restrictions. The Strait of Hormuz, one of the most important oil corridors on Earth, has become increasingly unstable. A huge percentage of global oil flows through that narrow passage. If that route becomes constrained, the impact on global supply could be enormous. And markets are already starting to price that risk. Europe is feeling the pressure immediately. Natural gas prices in Europe have surged sharply, with benchmark prices jumping more than 60%. That's not just a number on a screen. Higher gas prices mean higher electricity costs, higher heating bills, higher manufacturing costs, and ultimately, higher inflation. Europe has already experienced one major energy shock in recent years. Another one would be extremely painful. The energy shock is now spreading across the entire commodity complex. Shipping costs have surged dramatically. Liquefied natural gas prices have jumped. Jet fuel is rising rapidly. Industrial metals are climbing. And in the United States, diesel prices are surging again. When commodities move together like this, it usually signals something bigger than normal market volatility. It signals a systemic shock to supply chains. Financial markets in Asia were among the first to react. Major indices triggered sharp declines, and in some cases, circuit breakers. Technology-heavy markets dropped quickly as investors priced in both energy risk and geopolitical uncertainty. When Asian markets react this aggressively, it often signals global investors are repositioning risk. And once that repositioning begins, volatility tends to spread across the world. One of the sectors hit hardest has been semiconductors. Major chip manufacturers saw sharp declines. Why? Because semiconductor production is incredibly energy intensive. and many Asian economies depend heavily on imported energy from the Middle East. If energy costs surge, production costs rise, and profit margins shrink, which is exactly what investors are now pricing in. Interestingly, one asset has strengthened through the chaos: the US dollar. In periods of global uncertainty, capital often flows into dollar assets because of liquidity and stability. The dollar index has moved higher, while treasury yields have also remained elevated. This dynamic shows investors seeking safety, but also worrying about inflation. Because energy shocks are inherently inflationary, the shock is also visible in equity markets. European stocks have lost hundreds of billions in market value in a very short time. Major indices across Germany, Italy, Spain, and France have dropped sharply. Markets are reacting not just to current events, but to the risk of prolonged energy disruption. And once investors start worrying about energy security, entire regions can become vulnerable. Meanwhile, hedge funds are rapidly increasing short positions. Volatility indexes have surged. Short bets against equities have increased. Professional investors tend to move early when uncertainty rises. They reduce exposure, they hedge risk, and they prepare for larger swings in markets. Perhaps the biggest macroeconomic concern emerging from this crisis is stagflation, a dangerous combination of slow economic growth and rising inflation. Higher oil prices push inflation higher. At the same time, higher energy costs slow economic activity. That combination creates one of the most difficult environments for central banks, because fighting inflation requires tight policy, but slowing growth requires stimulus, and those two goals collide. Just weeks ago, markets expected multiple interest rate cuts. Now those expectations are fading. Investors are rapidly repricing the future path of monetary policy. If energy prices stay elevated, central banks will have far less room to ease financial conditions, which means interest rates could stay higher for longer, and that changes the entire valuation framework for global equities. Governments are now beginning to react. Major economies are discussing coordinated releases of strategic oil reserves. Emergency meetings are taking place between energy agencies and policymakers. The goal is simple: stabilize markets, prevent panic, and ensure that energy supplies remain available. But whether these measures will be enough remains uncertain. Now, markets are turning their attention to upcoming economic data: inflation reports, oil inventories, consumer sentiment. These numbers will reveal how much of the shock is already spreading into the real economy. Because markets are forward-looking, they are constantly trying to anticipate what happens next. So, where does this leave investors? In an environment where volatility is almost guaranteed. When energy shocks collide with geopolitics and monetary policy, markets rarely move smoothly. But moments like this also create clarity. They reveal the true drivers of markets: energy, inflation, interest rates, and investor psychology. Because in times of uncertainty, the goal is not prediction, it's resilience. Capital preservation becomes the priority, and understanding the chain reaction of global events becomes the most valuable skill an investor can have.